right, so mortgage rates soared to their highest level in 21 years. This was put out by CNN August 17, 2023, and it's concerning, but not as concerning as some other things I'm going to show you as we dig a little deeper down the rabbit hole. And before we do that, let's kind of jump into this article and just get the base of what they're saying here. So if we scroll down, we see that the 30-year fixed rate mortgage averaged 7.09 in the week ending August 17th, up from 6.96 the week before. A year ago, the 30-year fixed rate was 5.13. Big change in percentage there. I'm going to show you how big in just a little bit with a chart and how that's pretty concerning. So let's scroll down here. We also got, mortgage rates have spiked during the Federal Reserve's historic rate hiking campaign, sending home affordability to its lowest level in several decades. Oh, how we gotta love the Federal Reserve, right? I'm not even going to talk about them right now. So basically what they're saying all right here is that what's happening is there's less people selling for the reason of they're locked into these lower rates, right? So it's something like 62% of people in 2022 are paying less than 4%, and then 82% are paying less than 5%, and then 92% are paying less than 6% as far as that 30% rate. And people don't want to get out of their mortgage, so instead of selling, they're just staying because they don't want to get a new house with a higher rate, right? Also, less people are buying because they can't afford the higher rate. So that's part of the change of what's going on here and what they're kind of talking about right here. So what I want to show you is kind of what we were talking about up here, where the average rate right now is 7.09, and this week ending now. A year ago is 5.13, so it raised 2%. I want to show you just how big that change is. So if we come over to this 30-year fixed rate mortgage average in the United States, and I have it measuring percent change from a year ago, we see a huge jump here from 2021 to 2022. And this graph goes back to about 1970, so it covers the last 50 plus years. And what's concerning to me is we've seen a jump like we've never seen before. And there's reasons behind this. So we see again from -5 to a little over 80%, that's an 85% jump. Now, if we look at the increases from before, the highest increase we've ever seen was in 1993. It jumped from about -13 to about 14, which is about a 27% jump. The jump we saw from 21 to 22 was more than three times larger than that. So it's a little concerning that we see a jump like that because we've never seen this before and anywhere close to this level. It feels like 1.5 times of like, okay, that's something a little different, but this is totally different. There's a lot of things going on right now. I'm going to take you down some other rabbit holes right now that are behind this, but an 85% jump in 1 year has not even come close to happening before. Not within 3 times. Again, the last time it came even 3 times less than happening, less than 3 times less than happening, is 93, 94. Okay, so let's pay attention to that, number one. Let's also go take a look at something else. Let's go take a look at all transactions for the house price index for the United States. Now, first look at this chart. It doesn't look too bad, right? Like it's going up somewhat nicely here. You see the dip here when we had 2008. It's going up again, and we start to see a dip a little bit. Maybe say, well, is that like right here? Maybe, possibly, but I want to show you something more concerning. So if we change the units to percent change from a year ago, what do we see? We see an extremely large drop here, okay? Very steep drop, the steepest one we've probably ever seen, okay? And what I want you to kind of pay attention to is what happened with the other steep drops before. Well, all the way here back in, 78, 79, we start seeing a steep drop. We hit a recession in 80, keeps dropping. We hit a big recession in 82, right? This drop right here, we start dropping, and we hit a recession right here in 90, 91. Right? This one starts dropping and it actually hit the recession in the drop. This one drops majorly, right? Kind of almost like this one, but not as steep. And we had a huge recession in 2008. Now, in 2021, going to 2022, we have a major fast drop here, going down extremely fast, even faster than this one here. Do you know what followed these other big drops? Recessions. And the bigger the drop was, the bigger the recession was. So that's something that's a little concerning as well. We can also take a look at household net worth. And again, if you take a look at this chart just by, this measurement, which is millions of dollars, well, it's not super concerning. You see a pretty much steady trend up. But again, if we change this to percent change from a year ago, we see a major drop off. And what do you notice? As before, when we have drop-offs, what follows it? A major recession, right? So we had a drop here. It wasn't a huge drop, but it also wasn't a huge recession. In 2002, we had a pretty big drop here, and it was a somewhat large recession. Right here, we have a major drop, and a big recession following it, like a major recession following it. Here we have the biggest drop we've seen going back these 40 years or so, whatever it is. Again, it's an indicator that possibly a very large recession, possibly even bigger than 2008, is due to follow. And again, there's multiple graphs that I can keep going into that are pointing to a recession, whereas it's not hitting yet because we have people that are trying to not let it hit. So let's go into some other graphs here. Let's go, and this ties deeper into the rabbit hole. Let's go into our federal debt, the total public debt since this graph shows since like the 1960. This graph right here shows since 1790. So this kind of gives you a bigger picture of where our debt's at and how we're in some serious trouble right now. And it may be starting to show here in some of this, the household net worth type stuff and the mortgage rates that we're seeing these crazy trends happening because our debt is starting to get to in a place where it's totally out of control and it's increasing at an exponential rate. So as we take a look here, we know from this bigger graph that, well, let's actually take a look at the bigger graph first. So we basically had no debt from 1790 to about 1913, right? 1913 is when the big change happened, where the Federal Reserve Act was established and the Federal Reserve could start manipulating things, right? But when it first started, they take inch by inch, right? They take a mile, but they take it inch by inch until they take a lot and it starts exponentially increasing. So 1913 was when the Federal Reserve Act was created. Okay. The next big change was actually 1944, which is when the Bretton Woods system was established. Okay. So that was when gold was set at a price of $35, which is never great. You always want a free market. You don't want to set the price of anything to a specific price. But gold was set at $35 an hour, and then it was pretty much backed by the US dollar, and it was like a worldwide thing. Well, Bretton Woods lasted until about 1971. It lasted till 1971. August 15th, 1971. If we go to that date, which is right here, this is the biggest one because what happened in 1971 when Bretton Woods ended was the gold standard was ended. So that means our dollar was no longer backed by anything, which means the government and the Federal Reserve could print as much money as they wanted because there didn't need to be anything backing it. So look what happened since 1971. Right? So now what I'm going to do is go into this more kind of zoomed in graph here. And we know before 66, there really wasn't much debt. This just gives us a better idea of what's going on. But again, if we go to the big graph, notice how quickly this debt is rising. Okay. And what I want to show you is something scary. So let's look at the debt from 2019 to 2023. Okay. So you see in 2019, we had a debt of 23 trillion. By 2023, it rose to 31 trillion. If you do your math, that is $8 trillion of debt created in just under 4 years. So $8 trillion of debt. You guys want to guess from 1790 until what time period did we have $8 trillion in debt? Well, we started in 1790, 1776 really. This is when the graph started. All right, by 1850, we're about 63 million. By 1900, we're only at 2 billion. By 1950, only at 255 billion. All right, we're starting to go up here. 2000, we're at 5.5 trillion. We got to 8 trillion in 2005. So it took us from 1790 to 2005, that is 215 years, to reach $8 trillion in debt. 215 years. We did $8 trillion of debt in the last 4 years. Less than 4 years. And again, if you look at this chart, look how fast our debt is increasing. This is scary. And this all ties into what is happening here, where how some weird stuff on these graphs has happened. Okay, and while we could be set for something where 2008 looks kind of minute. All right, so I just wanted to kind of show you my take on this. Yeah, the mortgage rate thing and them raising to their highest level in 21 years to me is not surprising at all. I'm not. How long this whole ball takes to drop just depends on how much longer they're going to kick the can down the road and how much longer they're going to cover things up and print more money. But the fact remains that they can only print for so long before things collapse. I mean, history shows us as a currency goes to fiat currency, it fails, right? Fiat currency in the history of time, there's been thousands of them. They have a 0% success rate. All right, we've been on a fiat currency now for about 50 years since Bretton Woods ended. The scary thing is the whole world is on a fiat currency now. That's never happened before, right? Before it was just like, one empire at a time would go on a fiat currency, and after so many years, they fail because with a fiat currency, there's no balancing, right? There's nothing like gold to balance things out, or there's nothing, backing the currency to balance things out. It doesn't have to be precious metals, although that's been what's been primarily used over the last few thousand years. So I just want to take you deeper down this rabbit hole of, yeah, mortgage rates are soaring to their highest level in 21 years, and that's not necessarily a good thing, but there's a lot of things that go deeper down the rabbit hole when it comes to that, and that's what I wanted to kind of show you today. So hopefully this kind of opens your eyes for some things. If you're interested in possibly looking into investing in precious metals, I recommend you go to investingingold.com/quiz. I have a long-term relationship with a lot of the companies out there, and I show you the best companies for you depending on what your answers are to those questions. And I believe the precious metals is about to explode here. It could be tomorrow, it could be in the next few years, just depends on when our government kind of gets their foot caught in their mouth, because it's going to happen. They can't keep doing this right here. This doesn't work. All right, the system is going to break. So hope you guys enjoyed this video. We will be back soon. Talk to y'all later.